Yeah, hello traders. This is Dan in the green trading room, and we just wanted to review a trade that we entered this morning. It's what we call a 0 day to expiration short credit spread that we love doing on option expiration day. This is Amazon, a 5-minute chart. And today on blowout earnings, I'm not showing you the daily chart, but it just blew up. Last night it was up 244 points. This morning it was up, I don't know, a little over 205 points. And I'm going to show you how we look for intraday setups to trade these short credit spreads. And they really can be on any instrument that gives us a compelling short-term turning point. So we'd sell out of the money calls if we're predicting a short-term top. We'd sell out of the money put spreads if we're predicting a low for the day. But we love doing them on earnings and gapping stocks because volatility is much higher. So if you would look at the option table, Amazon had an expected move of $56 last night. So the folks who shorted options into earnings on the belief that options are overpriced and I'm going to play the volatility crush game and everything's going to be wonderful, they got absolutely crushed today because of the gap up dwarfing the statistical calculated expected move, which we don't do at Master Trader. Our approach is to wait for the news to come out, the gap to occur, and then get an intraday setup. We still get the volatility crush, so to speak, because it's still going to be the implied volatility is still very high, particularly for the first couple of hours. So let me walk you through what we did in the green trading room, and for our subscribers of the weekly options trader, which specializes in just selling options that expire in 10 days or less, with the intent of the premium that we take in, that's our profit by predicting short-term top or bottom. So these vertical dotted lines are pre-market, and when we trade gappers, we use that in our decision making to enter a compelling pattern. So here it's sold off and broke down into the 9:30 Eastern market open. Here's where the market opened. Some of the traders in our green trading room shorted an out of the money bear call credit spread under a 5-minute low, and they got paid handsomely for that. They got a fantastic entry. And so I was waiting for a bounce. This is what we call a sell setup. So when it's up, 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 I got a reversal bar, I got a topping tail, and that's where we recommended to sell and out of the money. We did the 2085, and we just picked a $20 wide because buying the out of the money call is merely done just to minimize the buying power consumption to put this on. We sold it for $1.50 a share. As long as Amazon closes below this 2085 short strike price, then that $1.50 a share is 100% profit. Now, none of you should be doing a 10 lot unless you're experienced, but if you did sell a 10 lot, that would be $1,500. Now, another point, so it's an open trade. Our stop is above this pre-market resistance, and we're in management mode. But I want to show you here in real time an additional benefit of the rapid time decay and rapid volatility contraction that we're profiting from this volatility crush. So the stock's actually right where we entered it, maybe a dollar or two against us. But if we were to close the trade right now, it is 93 cents a share right now. The midpoint, I'm looking at it. So that means we've made over 1/3 of the maximum gain of that $1.50 credit per share. And the stock has gone nowhere or even against us a dollar or two, like I mentioned. So now I'm going to move the stop to break even at a minimum. So what that means is if that debit gets back to 150, that would only occur if the stock started rallying aggressively against us. Then we'll just call it a scratch. Once this breaks down, if it does, because the markets are weak right now, so we're hoping that it breaks down, We still got a big price void here. Then I will lower the stop to right here, just eyeball it at 2060, and then we'll try to cover it at, just for a penny or two into the close. Actually, let me show you another one that we're in that we did yesterday with a very, very similar approach. This was Tesla, also at a big gap up. Tesla has been on an incredible tear over the last couple months, more than doubling. So this one here's pre-market, and it didn't give us a great setup at first, but we did it right on a break below this red bar, and then it just bobbled around. We're still in it. We had a nice, we made, even though it went nowhere again into the close yesterday, we still had 2/3, or maybe half of our maximum gain. Now, it's a nickel to close it. Let me get the number. We sold this one yesterday at 85 cents a share, and right now it is 4 cents. We could close this one out at 4 cents if we wanted to, but I said, you know what? Move the stop to the day's high and bid 1 penny to get out. And that's our current management of Tesla. So that is it. Hope that helps. And these are just 2 real examples to show you what we do every day in looking for short-term credit spread opportunities using the charts. Spiders, by the way, have multiple expirations. So we're looking at they have expirations Monday, Wednesday, Friday, and then on the monthly and quarterlies on Thursdays. So whenever we find a short-term top or bottom on 0 DTE days on spiders, this is one of our go-to trades. We love it. And I know that some folks in our green trading room at this sell setup right here, an M top on the 15-minute chart, right under this red bar, they were selling out of the money bear call credit spreads on the spiders or the big contract on the SPX. So that is it. Hope that helps. Good trading, everyone, and we will see you next time.